Everyone, and I think we are rolling into the third session for fixed income. So we'll pick up on yield and yield spread measures for bonds, right? So there are different types of ways to calculate yield and measure the yield. So we are getting into that yield and yield measures for the bond. Okay, perfect.
So to the
So
camera is possible for you to
Oh yeah.
on the
Sorry, sorry,
camera?
sorry, 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 sorry. Yeah. I have fixed that. Oh, yesterday I had to change the
Okay.
laptop due
Thank
to an issue, but yeah. Ah, sir, perfect. Okay.
you.
Okay. So yeah, let me just set this up on my system and actually perfect. So we are getting into yield and yield spread measures for fixed rate bonds. Now, the outcome is calculate different types of yield and interpret those yields largely from a fixed income perspective. What are the different types and ways of calculating and interpreting these yield measures? Now, in this, the first thing that comes is obviously periodicity, the concept of periodicity. And the concept of periodicity is not only for fixed income. I think this is something which you will also read when you do quantitative methods or quantitative theories as a concept. So it's pretty simple, right? When we say periodicity, periodicity means the number of compounding periods per year. Now, it could be annual compounding, it could be semi-annual compounding, quarterly compounding, anything else, right? It could be a daily compounding. Remember when we said yesterday we were discussing semi-annual, we said you should divide your rate by 2 and you should multiply your time by 2. So it's pretty similar. If I say periodicity, the simple general rule is R by N time multiplied by N. So rate should be divided by N, which is your number of period. If it's quarterly, by 4, and time should be multiplied by N if it is quarterly, 4. So for semi-annual, periodicity is 2. For quarterly, periodicity is 4. For annual, if you're doing, obviously there is no periodicity, it's 1 by default, right? But again, these are not the only periodicity measures you might work. Sometimes you may need continuous compounding, and in that case, we'll change the formula. But always remember, if someone says periodicity, we are looking at these two basic adjustments. Any rate that you have, any percentage that you have should be divided by your periodicity number N, and time should be multiplied by your periodicity number N, right? So if it's 10% per annum, and if I say quarterly compounding, then your input will be 2.5%, right? We'll divide it by 4. And if I say it's a 2-year bond, quarterly payments, you're going to take N as 8 periods. Now, this is necessary because if you are going to convert yields from one periodicity to another, let's say from quarterly to annual, then you have to change that formula accordingly. And that is why we say whatever is your APRs divided by M and N, whatever is your rate that we are looking at, annual percentage rates, accordingly, you can just work around the math and calculate your yield measures as well. So for us, this becomes important that we try and estimate the effective annual rates in most of these scenarios, because if you're not able to estimate effective annual rates, it's a problem to a certain extent. Now, just a quick example to explain this concept better from an example standpoint. It's a 5% $100 par bond trading, or bond trading at par, right? So coupon rate is given as 5%, right? Whenever it says 5% bond, that automatically means coupon rate. It is never YTM, right? So never confuse it with YTM. Whenever someone says a 5% bond, that 5% is coupon. $100 obviously has been given to you, that is the face value or the par value. And this is trading at par. Because this is trading at par, which means the present value of the bond is also $100. And we did discuss yesterday, a bond will trade at par value if coupon rate is equal to YTM. So automatically the YTM will be 5%, right? You don't have to worry about it at all. That is the only condition if coupon and YTM are the same, that you would be looking at present value and future value, or face value and present value equal for the bond. And now, therefore, we say calculate effective annual rate for different periodicity, EARs for different periodicity. For annual, obviously the effective annual rate is 5%, right? You are working with 5%. But for semi-annual, quarterly, and monthly, we have to look at an effective annual rate mathematics to that extent. Perfect. And that is exactly where we say if you're going to do an effective annual rate calculation, your coupons obviously are going to change, right? So for example, in this case, your coupons will be $2.5 because you're doing semi-annual. In quarterly, you will take $5 divided by 4, which will be $1.25. And in monthly, you're obviously going to save $5 divided by 12, right? So that number turns out to be 0.4ish, I think. Let's just quickly do it. So $5 divided by 12, yeah, 0.42 or 0.4167. So that becomes a $0.42 coupon. So if I have to do a effective annual rate calculation, right? That calculation starts with first estimating coupons. What will be my coupons if I adjust it for different periodicity? So just a minute, hold on. Just a minute, someone at the door. Perfect, no problems. I think where we can start. Okay, so these are my coupon payments, right? And now I want to calculate effective annual rate. So we are going to say 1 plus the coupon or whatever the rate is, right? So like 0.25, that is 2.5%. Or you can straight away add 0.025 to your number. 1 plus 1.25%, 1 plus 5% or 0.41 or 42%, right? So these numbers will be added and these numbers will then be raised to the power n. So in this case, the n will be 2 because you're doing semi-annual. In this case, the n will be 4. You're doing quarterly, 12 and minus 1. This should give you your effective annual rate. If you look at the formula, is not too different. It is compound interest, simple. 1 plus r raised to the power n minus 1, right? And we always used to write r by n when we used to do compound interest. So it's pretty much the same. 1 plus 5% by 4 if you're doing quarterly raised to the power 4 minus 1. That is exactly what we have done here, right? So it's nothing but compound interest formula. We are just writing it to calculate our effective annual rate. What is EAR? EAR basically says although the coupon is 5%, but you are going to make more than 5% if you do it semi-annual. If you do it quarterly, even more. And if you do monthly, even more returns will be possible because then you are going to get coupons on a monthly basis, right? And these monthly coupons will largely be useful from your perspective because monthly coupons will eventually translate into uh, a higher interest on interest number, right? You will typically get paid interest on interest over a period of time. So for our purposes, annual returns will only be 5%. This will be more than 5. This will be even more than semi-annual. This will be even more than quarterly numbers. Okay. So just keep a track of this, that when you're doing annual effective annual rates, as I said, 5%, 5.06, 5.09, and 5.11. The returns will keep increasing over a period of time because now you're going to get interest on interest as a concept largely. So you will have to calculate if compounding periods or make adjustments for periodicity. Now, what are the other measures that you can use to estimate bond yields, right? It's not only that we are going to calculate effective annual rates and that is the only number that we are going to worry about when we are doing bond yield calculations. There are different ways to represent it. For example, there is street convention. Now, when we say street convention, YTM calculated assuming payments occur on scheduled dates and ignores weekends and holidays, right? And this is therefore simplifies calculation. That's the convention. That is generally what we all work with. There is a possibility if you are going to make the payment on December 31 is a Sunday, right? But we don't make that changes that, okay, on Sunday there will be no payments made. We assume that the payments will be made on the stated date and simplifies convention. That is the simplifies calculation. That is generally the convention which everyone works with. Then there is a true yield. YTM using actual calendar, which avoids weekends and bank holidays. Payment will occur slightly later, and true yield, therefore, is always less than the street yield. Okay, so there is a possibility if there is a holiday, the payment will be made a day after the holiday. So in that case, the true yield will be less than the street convention yield or street yield. Government equivalent yield converts a YTM based on 30 by 360 day count to actual by actual to make yields comparable with government bonds. Government bonds are actual by actual. Okay, government bonds uses actual by actual to do all the calculations. And therefore, if you have a YTM based on 30 by 360 day count, the government equivalent yield will convert it to actual by actual basis. Why will that conversion be necessary? To ensure you can compare your yield with government bond yields. Otherwise, there will be a small difference in the way the calculations are done. Current yield, I think if you remember, we did talk about current yield in our first class on fixed income, and we said current yield is nothing but annual coupons that a bond pays divided by the price of the bond. Now you can call it the flat price of the bond. So current yield is annual coupon upon flat price. And then there is a simple yield where you say annual coupon. To the coupon, you add one more thing, which is amortized gain or loss. And this represents the full return without full YTM calculation. Now, what is this amortized gain or loss? Remember, yesterday we talked about a graph which was like this pull to par graph. We said that you can start at 105 rupees, you can start at 95 rupees, bond can be at a discount, bond can be at a premium, but the bond by the time maturity comes of 3 year will retire at par value of 100. So this reduction in the value from 105 to 100 or increase in the value from 95 to 100 is called as amortization gain or loss. So that is typically added to the annual coupon and divided by the price of the bond to calculate what is called as simple yields. This approximates the full return. The current yield only approximates the income return because your income is only annual coupon. Doesn't include the capital gain component. How much capital gain you are going to get, that doesn't include in your current yield. That capital gain in a way is included here. I think the alternate way to think about this and understand this is when you buy shares, you get dividend, right? And when we say dividend by price of the share, that is dividend yield. It only measures your dividend income. But if I say dividend plus the price at which you sell divided by the price per share, this is your total return, which includes dividends plus the price at which you sell minus the price at which you buy. That is your capital gain also gets included in the total return. So simple yield is sort of total return and current yield is a type of yield, which is dividend yield or only the income return. Besides this, like we have talked about YTM, now we introduce another term called YTW, yield to worst. And what is yield to worst? The lowest yield among all possible yields. So for example, you could have a yield to call, you could have yield to put, you could have yield to maturity, and again, you could have multiple yield to call, multiple yield to put. Amongst all these yields, the lowest is basically nothing but your yield to worst, YTW. This ensures investors evaluate the most conservative return. That if I am looking at YTW, that is my lowest yield or lowest return that I'm going to get. So if call yields are 6.975, 6.956, 6.953, then YTM is 7.0. Yield to worst is minimum of all the numbers. So that's as conservative as it gets in terms of the estimation of yields. Then comes option adjusted yield, one more type of yield, but this is only applicable to bonds which are called as embedded option bonds. If you remember, we talked about three types of bonds: puttable, callable, and convertible. These three types of bonds are bonds with embedded option. So option adjusted yield adjusts yields by removing the impact of options, right? It will make an adjustment to the yields by removing the impact of the embedded option. Steps: compute option adjusted price, which is flat price plus value of the option. Calculate the yield using the option adjusted price and reflect the yield of a comparable non-callable bond. So in this case, step one, we are going to calculate an option adjusted price. It's a price. It's nothing but a price. And if your price is nothing, is your future cash flows, present value of all your future cash flows. So we are going to calculate an option adjusted price, flat price plus the value of embedded option. And what is this value of embedded option? Value of embedded option is the value of a callable bond minus the value of a non-callable bond, right? Difference between the two. Callable bonds typically have lower prices because options hurt investors. And if you remember a bit of it, callable bond were disadvantage investor. Disadvantage investor, because these are disadvantage investors. A normal bond will sell at 100, a callable bond will sell at $98, and this $2 is basically your discount that your bond is selling at. Whereas putable bonds are desirable. Putable bonds are something which are desirable from an investor perspective, and they therefore sell at a premium to a lot of other similar bonds. So OAY, the assessment or the need of an OAY is it adjusts yield by removing the impact of embedded options. So if you're having a yield, it will adjust it lower or higher, and what you get is a yield without any impact of embedded options. What are the other types of yields and what it represents? Once again, like we did not talk about yield to call and yield to put as such, but YTM, we have talked about YTM. Return if the bond is held to maturity, right? Yield to maturity. If you buy the bond today and if you hold the bond till maturity, the return that you're going to get is your yield to maturity. When it's used, all standard bonds use YTM. Standard, when I say bonds without embedded options, right? If there are no embedded options, you're going to use bonds without embedded options. Then it assumes no early redemption. Why is there is no early redemption? Because there is no option, right? Which bond will have early redemption? Early redemption means early retirement of the bond. A bond which has callable or puttable features. A bond which can be called or a bond which can be put back. Called by the company and put, which means sold by the investor. So any bond which is a normal bond, right? A normal bond will have no premature withdrawals or redemptions. And therefore, YTM works brilliantly for such a bond. Yield to call. Return if issuer calls the bond on a call date. Now, yield to call basically, and callable bond, I'll repeat for you. Callable bond is a bond where the issuer can call the bond. So if I've given you a bond and any day I can say, okay, I want my bond back, right? So you will have to give the bond back and I'm going to make the payment to you. So this is a bond where issuer calls the bond on a call date, and callable bonds with scheduled call dates have this yield to call. So it's not necessary there's only one call. So what I can do, I can issue you a callable bond and I can give you call dates, right? So I can say call date, let's say January 15, April 28, May 15, three call dates. And I'll tell you, if I'm going to call on January 15, I'm going to give you $100. If I'm going to call on April 28, I'm going to give you $101. And in this, I am going to give you $103. It's up to me. When do I want to call my bond? Right. So this is a call schedule, callable bond with scheduled call dates. And in those scheduled call dates, you are also given what will be the price at which the bond will be called back. Right. So both the information are available to the investor. Measures return under each call scenario, right? So there will be a yield to call here, there will be a yield to call here, there will be yield to call here. This will be called as yield to first call, because this is the first day when the call can happen. And then yield to second call and third call. So everything is yield to call, YTC, but first, second, third, different call dates. And similarly, you will have a puttable bond also. We are not showcasing puttable bonds here. It is not present on this list at least. Yeah, but there will be a puttable yield to put also, which means you can give the bond back to the company. You can sell the bond back to the company. That is an advantage for you. And in that case also, there is a put schedule which will be available. YTW, as I said, lowest among all YTCs, YTMs, and YTPs. Puts should also be added a yield to put. Again, yield to worst can be calculated for any bond. Investors' most conservative return, which means this is the lowest return you are going to get, which is why this is called YTW, yield to worst. You're going to get the lowest return here. OAY, option adjusted yield, yield after removing option effects, which means with use option adjusted prices, could be only for bonds which have options, right? So embedded option bonds, there are only three embedded option bonds which we have talked about, right? You have callable, puttable, and convertible, and reflects yield of a comparable non-callable bond. These are different yield measures, right? As I said, these are different types of yields that we are trying to assess and work with. Questions? And if you forgot, I think it's important to repeat the callables and puttables again and again because a lot of discussion is based on that. A callable bond, which means the bond can be called. And who is going to call the bond? The company who has given you the bond. They are going to say, give me my bond back. They can call the bond. So if interest rates decrease, the bond prices keeps increasing. If it is a callable bond, the issuer will buy it back at a fixed price, and this price is called your call price. It will not go beyond this price. It will be just bought at this price. So if interest rates or YTMs decrease, price of the bond increases, the issuer will not wait for the price to go very high, and the graph of this callable bond will typically take a shape which is slightly different. Right? So this is your callable bond graph, the one which you see in blue. The red is your normal bond graph. Similarly, puttable bond, this is your normal bond. And for puttable, you are going to sell it back. So in puttable, what you will do, if the interest rates start increasing, the price will start falling. And therefore, if you have a puttable bond, you are going to sell it at a price higher. So this is that price, which is your put price. So if YTMs increase, interest rates increase, price falls. And if price falls in a puttable bond, you put the bond to the company. You sell the bond to the company at a price which is higher than the market price. This is your market price. Okay, 5% 3-year semi-annual pay bond, par $100, trading at $98, and coupons paid on Feb 1 and August 1. What will be the street convention YTM? What will be the impact on true yield compared to street convention YTM? Please give it a try. Give it a quick try. Street convention YTM is what you generally calculate based on your calculators, right? So street convention YTM is your standard calculator outputs. Given this is a semi-annual bond, I want to just cover one additional aspect here. Let's see how much is your YTM first, and then we'll talk about it. So give it a try. Semi-annual bond, I'm sure the basic math is fairly clear. The face value, $100, present value, $98. Okay. And obviously, when both the things are available, the face value and present value, always put face present value as negative in your calculators because you are going to spend $98 to buy this bond, right? So that $98 goes out of your pocket. N, 3 years into 2, because this is semi-annual, so 6. And coupons, which is your, we have 3-year 5% coupons, right? Coupons. So PMT key will be 5% multiplied by $100 divided by 2, just $2.5. So you should get your YTM. Let me also just quickly do this. $2.867. You're going to get a YTM 2.867%. Yep. But remember, this YTM is also sort of semi-annual YTM because all the numbers you have put in are semi-annual numbers. So YTM is also semi-annual. So therefore, your concluded YTM will be this YTM multiplied by 2, which is 2.867 multiplied by 2, 5.735%. So this is your street convention YTM. Street convention means we are assuming actual by actual. Let me know if there's an issue here, concerns. And what will be the impact on true yield compared to street convention YTM? You don't have to calculate it. But we do realize that if it is a true yield, you have to check is February 1 and August 1 holidays, right? And if they are holidays, depending if year has been given to you, but let's say assuming they are holidays, the true yield we have already said will be less than your street convention YTM. So the impact will be true yield is less than street convention YTM. Give it a look. If you have questions, please let me know. All good? Chaliye, perfect. If this works for you and if you don't have any doubts, remember for semi-annual, you have to multiply by 2 because your output is also semi-annual. 5.74. And yes, if there are bank holidays or weekends on Feb and August, then the coupons will be delayed and therefore true yield will be less than your street convention yield. Sorry. Okay, let's try another one. Give it a quick try. Current yield and simple yield. And we'll talk. Take 2 to 5 minutes. And if you have questions in the previous one, let me know. I can also help you with that. But if you're okay with the previous question, I think you can try example two. We'll wait for your solutions 3 to 5 minutes, and then I think we'll discuss this. Yep. Any answers?
So for first one, it is 1.0204.
1.0204. Okay, so current yield, the formula is annual coupons divided by the flat price or the price of the bond. Now, what are the annual coupons here? It is a 5% bond, right? So annual coupons are 5. That is for sure. Even if it is a semi-annual bond, but you're total going to get $5, right? So there should be no problem with that. And it is trading at $98. So 5 upon 98, that should be your current yield. And I think that comes different than 1%.
5.10%.
5.1%. Yeah, perfect. So what went wrong? So that is something I think should be the answer. Now,
Correct, sir. Yeah, I did
the
something.
sim yeah, for simple yield, $5 is annual coupon. And what is the discount? Now, how do you calculate a discount? So the bond's face value is $100. The price of the bond is $98, which means the discount is $2. And this discount is for a 3-year period. Okay. Oh, sorry, my calculator fell down. No problems. So I have a $2 discount in 3 years, right? So every year the pro rata discount will be 2 by 3. The $2 discount. Remember the pull to par graph, the bond is issued at 98, and in 3 years the bond has to go to 100. So every year in 98 we are going to add 0.67, 0.67, and 0.67 to get to $100. Okay, so the pro rata discount is 0.67, and this number divided by bond price. Bond price is what? $98. Perfect. So this is, I think, your simple yield. This plus 5 divided by 98, 5.78%. So when we say amortized discount, prorated discount, it's all about what is the discount and how many years is that discount going to be spread over. Perfect. 5.1% and 5.79%, $2 discount amortized over 3 years. So annual discount is 0.66 or 0.67. Let's put it this way. All good? Okay. Give this a try. Give this a quick try. You will have to use your calculators to do all of these calculations. The only thing that is going to change, and the hint, yield to maturity, I'm sure you can do. That should not be a problem. In these two, the only thing that you should change is your face value. Because if I'm going to call your bond in 3 years, I'm going to pay you this. Okay. So yield to call, the face value has to be changed, because if the bond is called, you are going to be paid 103, not $100. And then minimum of the two obviously is yield to worst. Give it a try. I'll wait for your answers. Let me know once your answers are ready. Semi-annual pay bond, 7-year coupon rate, par, trading at YTM should be easy peasy.
Sir, YTM is 2.89?
2.89, sir. Uh,
Yes,
you will have to obviously multiply that by 2, because you're doing semi-annual, right?
yes,
So we
semi-annual.
just, correct. So we just talked about this, that if you get a semi-annual YTM, that semi-annual YTM should be multiplied by 2 to conclude. So if you're getting 2.9, I don't know whether that is right or not, but I think that should be multiplied by 2 to get to a number. Let me just try. I just said
YTM is
my
5.78, sir.
5.78.
5.78.
Okay,
Yes.
let me just try, sir. Perfect. So this is a $100 bond, semi-annual, right? So this becomes my PMT. 14 becomes my time period. 100 becomes my face value, and trading at 106.5. This becomes my present value. Compute I by Y and multiply that by 2. So it should be 5.4%, I think.
Yeah, 5.373 to be precise.
5.37, correct. So the inputs will be n is equal to 7 into 2, 14. I by Y is equal to, I by Y we have to calculate, that is your YTM. Present value will be minus 106.5. Remember minus sign because you're going to pay that amount. Face value $100 and PMT 6.5% multiplied by 100 divided by 2. And this will give you, divide by 2, 2.686%. Obviously, you will have to then multiply this number by 2 to conclude on a YTM of 5.373%. So that should be your, I think, YTM number.
For yield to call, it is 5.74.
Yield to call 5.74. Let me just do this. So only the face value will change, and one more variable is going to change.
So what will change apart from
Think. We are doing yield to call. So what happens when the bond is called? What will happen to the bond?
N will change to 6.
N will change to 6, because what is going to happen if I call the bond from you after 3 years, the bond is dead. the bond is no more available in the market. Okay, so for yield to call, the changes would be N will become 3 into 2, 6 years or 6 periods. Because after 3 years, if the bond is called, the bond is dead. The bond is not no more alive in the market. Okay, I by Y, obviously we have to calculate. Present value will be now still the same, 106.5. Face value 103.25, because this is where the bond will be called, and PMT will remain the same, 6.5 by 2. And whatever number you get, obviously multiplied by 2, you should get 5.1496%. 5.15%, let's put it this way.
Yes.
Now, a very important aspect in fixed income that all of you should understand here. N. So should N be equal to remaining time, or should N be equal to time elapsed? Okay, this is one thing that may come to your thought process someday, that N should be equal to the time remaining, or should N be equal to the time completed? The answer is very simple. If the bond is going to retire, then it is time elapsed. Like callable bond, the bond will retire after 3 years. It will not be alive. Puttable bond, it will not be alive. But if the bond is just going to change hands, I'm going to sell it and you are going to buy it, then remaining time, because for you, there are still 4 years left. Out of 7 years, after 3 years, if I sell this to you, 4 years are still left. So always look at the question in terms of assessment. Is it talking about remaining time, or it will not tell you always whether it's remaining or it is elapsed. You have to just look at the condition. Is the bond dead? If yes, time elapsed, because there is nothing remaining. If the bond is dead, there is nothing remaining as time. And YT to W obviously is minimum of the two numbers. So we have 5.4% and we have 5.1%. So YTW is nothing but 5.14%, similar to YTC. Did we understand our mistakes? One, whenever you compute
Yes, sir.
semi-annual YTM, remember to multiply by 2 to conclude. If you don't multiply by 2, that is one error. Second, obviously, in yield to call, yield to put, the face value is going to change based on at what value you are going to call or at what value you are going to put. And the time will be when is that call going to happen or when is that put going to happen. That is the only thing. So sometimes when you set your calculator numbers, don't change everything. Just change the important elements and it should work wonderfully for you. Fixed income mathematics is actually very easy in level 1. A lot of people, when they give level 1, it just it's a, I don't know, it's a myth, it's a prejudice, a perception that level 1 is tough. If you get the math right, one thing is for sure, your questions on the mathematics side are easy and you can quickly just wrap it up, because you will have to spend a bit more time on theory. And the game changer in level 1 is theory, right? The person who can just try and remember the theory, answer the theory, is the game changer. uh, Numericals, most of the people will be able to manage because calculator is a major help, and if you once understand the construct, I think it's relatively easy. Okay, let's give this a try. 6.5%, 7 years, semi-annual pay bond, par $100, trading at 106, callable in 3 years at 103.25, YTM of 5.38. Similar 6.5%, 7-year semi-annual pay bond, par $100. So look at this: 6.5, 6.5, 7-year semi-annual, 7-year semi-annual, $100, $100. This is callable, trading at 106. This is no call, trading at 109. Okay, so one bond is a callable bond, and the other bond is similar non-callable bond. Nothing different. Everything is the same. The only thing is this is a non-callable bond. That is the key difference between the two. Calculate the value of the call option. Now, very simple. Price of non-callable bond minus price of callable bond is the value of the call option. How do you remember this equation? Simple. I tell you, you have to buy iPhone 17 and you have to buy iPhone 16. And if I ask you what is the difference, why is there a difference in the value of the two? You may say that I have no idea actually what these phones trade at, but iPhone 17, let's say, is 1.5 lakhs and iPhone 16 is 1.3 lakhs. The difference of the two, which is 20,000, is nothing but the value of additional features, if any, you are getting as part of iPhone 17. So similarly, the reason why callable bond is trading lower than non-callable bond because it is a disadvantage to the investor. And the $2.5 difference between the price is the value of the call option. So for us, that is $2.5 as the value of the call option. Okay. This is a concept which is always applicable in finance. Value with something, value without something, and the difference is that something that we are talking about, the feature that we are talking about. I can tell you a value of a home with swimming pool, 2 crore, without swimming pool, let's say no swimming pool, 1.8 crore. And I say everything else is the same. The only difference is one house has a swimming pool, the other does not has a swimming pool. The 20 lakh rupee difference is the value of the swimming pool. Simple. Because everything else is the same. Okay. Option adjusted yield. Now, how do we calculate option adjusted yield? So, look, a callable bond is trading at 106.5. Okay. And 2.5 rupees is the value of the option, which means option adjusted price, right? The formula that we should look at it is option adjusted price is equal to value of call option, or rather price of callable bond plus value of call option. So I'm going to say my price of callable bond is 106.5. Value of call option is 2.5, and therefore this becomes 109. So an option adjusted price is 109. Now what is an option adjusted price? This is price of a bond if it had no call option. Okay. And if it had no call option, a $109 bond is trading at a YTM of 4.96%. So the option adjusted yield should be 4.96%. It is a yield which represents returns without call option. If there is no call option, what will be your returns? Give it a quick look. 4.96% and $2.5. Anything that bothers you? All good? Okay, perfect. Then let's move forward on our discussion here to the next discussion parameter here, yield spreads over benchmark rates. Now remember, Yield to maturity has two components, the benchmark and the spread, right? So when I say that the yield to maturity on a bond is 8%, that means that 8% is based on this plus this. The benchmark is typically a risk-free rate of return, which means government bond, 6.5%. And this 6.5% of government bond yield, this is government bond or government security yield, GSEC, is based on two things, expected inflation and real rate. Okay, so to this benchmark, we add a spread, and that spread is the risk premium. What is the risk? If I'm going to give this bond or sell this bond as a company, as a corporate, there is a taxation risk, liquidity risk, credit risk, and there are so many other risks, operational risk. So 6.5 plus 1.5%, let's say, gives me a YTM of 8%. If the risk is more, this could be 2.5%. If the risk is even more, 3.5%, this could go anywhere. It all depends what is the risk profile of the business. Higher the risk, higher will be the spread. So that is parameter number one, that the benchmark is always government bond, and the government bond is based on inflation and real rate. And then there is a spread which is based on risk premium, and risk premium incorporates all different types of risk. The benchmark spread can further be classified into different categories. Like there is a G spread, government, interpolated spread I, a Z spread, and an OAS, option adjusted spread. So the yield spread over a particular benchmark is called benchmark spread, right? The generic word is spread, but over a particular benchmark, it is called as benchmark spread. For example, difference between 10-year corporate bond and 10-year benchmark rate, that is a spread. First one is G spread. The yield spread over government bond is known as G spread. Simple. If you're the one which we talked about in the previous example is a government bond spread, so that is a G spread. The difference between yield spread of a bond over the standard swap rate in that currency of the same tenor is known as interpolated spread. So if you're not doing government bond, but you're doing swap rates in the same currency, same tenor, then that is interpolated spread. Now, for you in exam, you should be able to calculate G and Z and OS. We don't have interpolated spread calculations or as part of scope anything around interpolated spread. You should be able to just answer the theoretical definition if required, but G spread calculations are expected. Simple. Subtract government bond from the corporate bond yield. Z, it is the constant spread added to the spot rate. So if you see, it is added everywhere, constant to the spot rate. These are spot rates. It is the constant spread added to the spot rates. The Z spread can be calculated with the help of following equation. So you will put your coupon payments. You will put spot rates Z1, Z2 or S1, S2, SN. I'm sorry. And then you will try and find a number Z which equates this to the present value. Which is why it says it is a constant spread added to the spot rates. And when you add it to the spot rate, this should make your right hand side of the equation equal to the left hand side of the equation, which is present value of the bond. So if I tell you the bond is trading at $89.5, $5 of coupon, $100 of redemption, and S1 is 4%, S2 is 5%, I'm sorry, this is 6%, you will have to find a Z which makes the equations equal. That is the Z spread. The only way to solve this in the exam, you will be given three options. Pick each option, put it here in the Z, and just answer. See, wherever your present value turns out to be 89.5, that is your correct answer. Then comes option adjusted spread. The spread calculated by subtracting option value from the Z spread. It is an option adjusted spread. So we already talked about how to calculate an option value, like a call option value. Remember, value of call option was non-callable bond minus callable bond. But we should also talk about put option. Value of the put option is puttable bond. It is slightly opposite minus the non-puttable bond, because puttable bond trades at a value higher than non-puttable. Okay, so you may be expected to calculate G, Z, and OS. All three are expected from your perspective. Again, they will straight away provide numbers, so it's more of a plug and play game from a exam perspective. Quick example, a 6.5% USD annual coupon corporate bond has 4 years remaining trading at 99.01. The 4-year government bond has 5.5% annual coupon. Find the G spread. Give it a try. The equation is simple. You have corporate YTM minus government YTM. Remember, you've been given spot rates here. So that is one change. In government bonds, spot rates will be used for discounting. So the government bond is going to pay you 5.5% annual coupon, right? So what you are going to get, you are going to get 5.5, 5.5, 5.5, 5.5. Plus you're going to get 100 more. In government bonds, we have to discount this using spot rate, 4.127% raised to the power 1. 5.5 divided by 1.1 plus 4.768% raised to the power 2. So every time you will have to use a different rate to discount these numbers. Add the numbers, whatever that number turns out to be is the price of the bond. And when you know the price of the bond, you already know it's a 4-year bond, N equal to 4. Coupon is equal to 5.5, which is PMT. Face value, you can take any face value, let's say $100. Price, you will already calculate here, and you will get the government bonds YTM. That is step 1. You will have to calculate the government bond YTM. And for government bond YTM, remember, you will have to use the spot rates for discounting. Government bonds will be discounted using spot rates. And then you will have to find the corporate bond YTM. Let me just for quickly also look at my Excel sheet and do this for you, because we'll have different numbers, so we will have to discount it using different rates. Okay, my Excel is ready. And in the interim, if you can get a corporate or the government YTM, let me know what your numbers are. Oops, sorry. The Excel visible to all of you?
Yes, sir.
Okay, perfect, chaliye. So what is the data that I'm working with? Let's first look at government bond YTM. So obviously year 1, 2, 3, 4. I have 4 years of data and I have four different spot rates, 4.127%. This I think you will have to do largely manually because there's different cash flows. So there's no other way to solve this for now, I think. I'm going to get obviously $5.5 of cash flow from the government and I'm going to get $100 afterwards, which means my total cash flows will be these in year 1, year 2, year 3 and year 4. And these cash flows should be discounted using these rates and time. So I'm going to say 5.5 divided by 1 plus this rate raised to the power 1 raised to the power 2 different rate raised to the power 2 different rate raised to the power 3 different rate raised to the power 4. And my price of the bond is 98.85. That is government bonds price. And now if I have government bond price, I think the YTM should be fairly easy. We can simply say the government bond is a 4-year bond. Yes. PMT is 5.5. Face value is $100 and present value obviously will be negative 98.85. So what is the YTM for this government bond that I can do here? So you can do it on your calculator. I'll quickly try and see if my Excel also gives me the same numbers. Turns out to be 5.83% YTM. For the government bond. So this is something your calculator should also give you as output. Step 1, any concerns on estimating government YTM? Anything that you missed out, you want me to explain again on this? This is step 1 because until unless we don't have the two YTMs, we cannot get the G spread. Okay, perfect. For corporate YTM, because that is the next number which is pending for us. For corporate YTM, we have been given some information already. So what is the data for corporate YTM? 6.5% USD annual coupon corporate bond has 4 years remaining, trading at 99.01. Perfect. So you have everything then. 6.5, 4 and 99.01. Okay. So corporate YTM should be easy. We'll just copy this here. 4 years, $6.5, semi-annual or annual? Annual coupon bond, trading at 99.01. And this is your YTM for 6.5, 6.5, right? Yeah, 6.5. Perfect. 6.79%. And G spread therefore should be the subtraction of the two YTMs. Corporate YTM minus the government YTM. You're going to take 6.79 minus the 5.83 number. The G spread is 0.96%. Questions? All good? Okay, perfect. If you don't have any questions, let's just. So the 4-year government bond has a 5.5% annual coupon. Yeah, this is exactly the one which we did right now. They are getting an answer of 5.83%. What is our answer? 5.83%. Corporate YTM 7.04%. Why are we not getting 7.04%? I'm getting 6.79%. Ah, no, so make that correction. This should be $6.5. I think this should not be 6.75%. This should be $6.5 or 6.5% because I think that is what the question initially stated, 6.5%. Okay, so make that correction on the slide if you're going to refer to the slide. With the 6.5%, the number would be different. I think that the solution with 7% YTM is around 6.75. If I'm also going to put a 6.75, I'll also get a 7.04, right? Okay. That's okay. So yeah, I think our answer is correct rather than this. Yeah, if you're working with 6.75, then this is the right answer. If you're working with 6.5, there will be a slightly different answer. Clear? Questions? Perfect. Okay. And one more example on Z spread. And now you will notice there are three options given to you. 78, 123, 148 BPS or basis points. 0.78%, 1.23%, 1.48%. You have been given three options and you have to calculate a Z spread. As I said, Z spread is a number which is added to all of them. And when they are used in discounting, the value of the bond should turn out to be 99.01. So an equation which can solve this and brings the value to 99.01 is your right answer. Cash flows are fairly simple. You will write it like this. One side of the equation will be 99.01. The other side of the equation will be $6.75 of coupon. How many years? This is a 4-year remaining bond. 6.75, 6.75 and 106.75. And you are going to discount it with 1 plus 4.127% plus Z raised to the power 1. 1.4768% plus Z raised to the power 2. Similarly, 1 plus 5.912% plus Z raised to the power 4, and there will be a raised to the power 3 here. And out of the three, whichever Z when added here gives you 99.01, that is your answer. Simple. That's the hit and trial method, and that is the easiest way to solve these questions. I can obviously put this on an Excel sheet quickly for you. So let me just copy this, put it here. 4.127. I think the rates are the same, 4.768, 5.287, 5.912. The coupon will be 6.75. We are calculating Z spread. And in each of these numbers, I have to add a Z, right? That Z has to be added. This is the key difference. If you see the formula I've changed, I've divided my cash flow with 1 plus R1 or the rate plus a Z. I don't know what that Z will be, but in all the calculations, I will include that Z here, right? In all the 4 calculations, we are going to include that purple cell in my calculations. And wherever this price turns out to be 99.01, that is my correct answer. So let's put the first Z. Where is the cell? Here is the Z cell. The first one was 78 basis point, which means 0.78%. See, if I put 0.78%, my number is higher than 99, which means 0.78% is not the right answer. This 0.78% is getting added here. Okay, everywhere. Let's try 1.23%. And there is your answer. 1.23% gets you to the right number of 99.01. So the correct answer is 1.23%. If I put 1.48%, I will go below 99. So your right answer for Z spread is 1.23%. Yes, see this. They're adding 0.78 everywhere, discounting. The addition is not 99, but here 1.23 added, that number is 99, which is why this is equal to the trading price. So Z spread equals 123 basis point. You don't have to even solve the third number. Questions, concerns, anything? All good? Okay, perfect. Sharia, then we'll take a logical break here. It's 11:25 a.m. I think add 15 minutes of break time to this. We will start at 11:40 a.m. Perfect. So take a break, 15 minutes, and I think we will restart in 15 minutes. Okay, perfect. We're good to start then. Let's just set this up. Okay, next on our list is obviously yield and yield spread measures for floating rate instruments. Whatever we talked about is for fixed rate instruments till today. Now we are going into floating rate instruments. And from a floating rate instruments, just a quick recap in terms of what are floating rates and I think what we are trying to talk about when we say floating rate instruments. We are saying if yields increase, the value of the fixed rate note decreases, right? Because there is no way that your yield and your coupons will be largely related here, right? They are pretty much the same. So in floating rate, we say there you have fixed coupons, and so this is the market reaction to note becoming desirable. This FRN means, I think, fixed rate notes. They're saying fixed rate notes here. However, the value of floating rate note remain more constant as the coupon gets reset each period. So if yields increase, the next coupon reset will be higher, right? So therefore, when we say floating rates, the rate keeps floating, and because the rate keeps floating, they are generally trading close to the market value. How do we decide the coupon rate? And when we were doing floating rate or type of fixed income security type of bonds, we said there is a reference rate, and to this reference rate, we add a fixed margin. This margin is called as the quoted margin paid above MRR, and the required margin is the margin required to price the bond at par. So, in short, the fixed rate notes have a disadvantage. If rates increase, they will typically have a fall in value. In this case, if the rates increase, the coupons also tend to increase, and therefore, more or less, yields are equal to coupon rate, more or less. And if yields are equal to coupon rate, they will more or less trade at their par value or close to par value. Now, with this background in place, we would like to understand the yield measures for floating rate notes. Now, for floating rates notes, again, along with this, for floating rate notes, we also need to understand there are other parameters like forward rates that we need to consider. But for floating rate notes, given they have variable interest payments that reset each period based on reference rate, the margin over the reference rate compensates investors for the issuer risk, right? And that is what we've already talked, that whenever you go and borrow, there is a margin which is added on a benchmark rate. And this margin that we add is primarily capturing risk. And the biggest risk is obviously a default risk that we are trying to capture. So if issuer credit risk remains unchanged, I'm sorry. If issuer credit risk remains unchanged, the quoted margin is equal to required margin and the FRN trades at par on reset date. Important, only on the reset dates. Dates at which coupons will be reset. So they don't reset every day. There will be stipulated dates on which you're going to reset these coupons. However, if the issuer credit risk changes, the required margin changes, and this is called as the discount margin. The discount margin is the spread that makes the present value of cash flows equal to par value. So now if you see, there is a discount margin added everywhere. This is the quoted margin. And discount margin is the number like a Z spread. It's like a Z spread. It is not a Z spread, but it is like a Z spread, which makes your equation equal to the present value of the bond. Let's understand this using an example that I think at times does help. The MRR for a 4-year floating rate note is on a 3-month basis, right? So 3-month basis, currently 0.55% negative. Okay. And the quoted margin is 250 basis points. This is your quoted margin. The bond is priced at 97. Calculate the discount margin assuming a 30 by 360 day count. So the idea is you have to use this equation. You have been given what the bond is trading at, right? The only thing is, first we will have to solve for the YTM yield, right? I don't have the yield numbers here. Okay. So the standard approach to solve this, first we will calculate the coupon, right? 0.55% plus 2.5% by 4.4875. This becomes your coupon because you are going to reset it on a 3-month basis. So in 1 year, this is how your coupon will look. And because we are doing 3-month quarterly basis, we have divided it by 4. Starting number plus the quoted margin divide by 4. Face value 100, TMT 0.4875, present value minus 97, N 16. This is a 4-year floating bond, but because it's 3-month quarterly, 4 into 4, 16 N, and I by Y is this. Remember, like semi-annual, you will have to multiply your yield by 4 to complete the calculation. Now this becomes your yield. Discount margin therefore is the yield to maturity, or the yield typically minus your coupon rate here, 2.744 minus 0.55%, and that is minus of minus 0.55%. Okay, please remember it's minus of minus 0.55%, effectively gives you a 3.294% discount margin. Simple. The quoted margin of 250 basis points would have to increase to 329 basis point for the bond to trade at a par. You will have to give me this much discount, then only the bond will trade at a par value. And this is going to happen because your coupon payments keep changing. There is a floating aspect associated to coupon payments here again. Give it a quick look. Okay, perfect. Then recap in terms of money market securities, and we did talk about this previously as well, I think, in our discussions, that money market securities or instruments, securities with less than 1 year. The yield measures in the money market are annualized but not compounded. Remember, in money market, you are going to annualize and do not compound, unlike bonds. The key thing for us to remember from money market perspective, obviously, is maturity. That is obviously of utmost importance. But along with maturity, how do you convert these, right? So you'll have to convert money market yields into discount yields, add-on yields. There are different types of yields even for money market instruments, right? So we need to cover that part as well. Some yields quote based on 360 days. Oops, sorry. Yeah, some yields quote on based on 360 days and some on the 365-day parameter. Bank certificate of deposits, repos, and market reference rates typically quote as annualized add-on rates. And you will have to then make adjustments based on shorter tenure that you're trying to borrow for, while other like US Treasury and commercial papers typically annualize discount based on face value. So there is a possibility you may not get exactly the type of data you want. Then you will have to just work around with the data and see how you can get to a appropriate number from the perspective of calculations here. So for example, money market and bond market, what is the difference between the yield measures? How do you measure yields? Okay. Money market yields are annualized but not compounded, as we said, stated using simple interest, while bond market yields are annualized and compounded using standard time value of money formulas. Bonds YTM uses single periodicity, while money market instruments use different day count convention and maturities. Further, money market securities are use non-standard quotation methods requiring special pricing formulas, while bond market is more actively traded, so you get typically traded data. And money market rates are generally quoted as discount rates or add-on rates. A discount rate, assume days in a year divided by days to maturity, and FV minus PV by PV. And for add-on yields, okay, so there is, I think, one change here which you should note. This is a very small change, but this is the only change in the formula that you're going to notice here. Otherwise, the formulas look identical to that extent. A discount yield and an add-on rate. The discount always quotes between the price difference as a percentage of face value. So if a bond is trading at a discount, you'll simply quote a discount yield. That okay, 0.2% discount, 0.8% discount, 1% discount, and that is your discount yield. If it is trading at a premium, we are going to say add-on yield. That is an add-on yield of quarter percent or 1% and so on and so forth. But just be careful in terms of the calculations. One of them is based on face value, and the other is based on the present value or the price of the bond. Theory can test you around these concepts, at least the first three, and more specifically, the first two lines, that money market works on simple interest while bond market yields will work on typically annualized and compounded numbers. As an example, suppose that an investor is comparing the following two money market instruments, which offers the higher expected rate of return, assuming that credit risk are the same. So now we need to estimate where is the return higher. A 90-day commercial paper issued by Bright Wheel Automotive Corporation quoted at a discount of 0.12% for 360-day per year, and a 90-day certificate of deposit issued by CFP Bank quoted at an add-on rate of 0.12% for a 365 day per year number. You'll have to obviously use your formulas here. You have to use your discount rate formula, and you have to also use your add-on rate formula, and then we will be able to compare and answer which of them is a better measure, right? So when we say typically add-on or discount rate, so for discount rate, we have said you're going to take face value minus present value by face value. Yeah, even I tend to get confused at times in this. And the days, right? How many assumed days you have in a year? That is your starting point divided by days to maturity. In this case, so you have been given this 0.12% is equal to assumed days. This is money market, and money market works on 360 days. Days to maturity, 90-day commercial paper. So 90 days been given to you into the FV minus PV by PV, or you can simply call it the discount by 100. Right? You can simply call FV minus PV by PV equal to discount by 100. So solving this, whatever the number you get for discount is where the bond is going to trade, right? So if I multiply 0.12% into 90 multiplied by 100 divided by 360, 0.03. This is going to get to 0.03, which means the bond is going to sell at 0.03, $99.97. Now, sometimes you may think about it, how much does this really matter? 2, 3 decimal points here and there. In bond market, one decimal point, 2 decimal point is massive movements, right? In bond markets, even if the bonds move by 20, 30 cents, I think it's a big movement from a bond market perspective. So this is your basically the discount rate calculation. So 0.0012, 0.12%, 360 by 19 to discount by 100. Add-on yield or add-on rate. Look, for add-on rate, you don't have to do anything major, right? 360 by 90 remains the same. Face value minus present value by present value. So 100 minus 99.97 divided by 99.97. That is your add-on rate. And what number does this come up to? 0.03 divided by 99.97 into 360 divided by 90 to 100. 0.12%, right? This turns out to be, again, add-on yield turns out to be 0.12%. Okay. So when we say add-on yield, the add-on rate is also 0.12%, which means the commercial paper AOR is 0.2 basis point greater than the CFP Bank CD. Now look at the question again. CFP Bank was issued a certificate of deposit of 0.12%, while commercial paper is issuing a commercial paper at a discount of 1.2%. In either case, there was money to be made, but the investor was very clear until the issues are resolved. These numbers largely say that the AOR is greater for the commercial paper than the certificate of deposit issued by the bank CD. Okay. Keynote, because AOR is a bond equivalent yield, it's based on 365 days. So until and unless you work in a bond market scenario, these yields, I don't know how relevant will be for you henceforth. But from an exam perspective, obviously calculation is necessary because exams will test you on these calculation parameters. Okay, question. 4 different instruments, 2 discount rate, 2 add-on rates, number of days, quoted rate. Which instrument has the highest and lowest rate of return? For each of them, you're going to calculate a DR, standard math, not a lot of problems, I think, on a DR basis. And then we're going to do a bond equivalent yield. BEY is nothing but AOR. I think, please remember. I'm sorry if that confuses you. When we say a bond equivalent yield, that is nothing but an AOR that we are talking about. AOR on a 365 basis may be called the bond equivalent yield. Okay. So bond A, bond B, bond C, and bond D. You have bond equivalent yield for all 4 securities: 4.48, 45, 41, 45. And because A has the highest bond equivalent yield, that is the bond which is most desirable in this category. Suppose that an analyst prefers to convert money market rates to semi-annual bond basis so that the rates are directly comparable to yields on bonds that make semi-annual coupon payments. The quoted rates are given to you. We have to calculate effective annual rate and the YTM on this security. Please give it a try. If you remember effective annual rate formula, that was 1 upon the rate divided by n, right? And we said raised to the power n minus 1. So in this case, we are going to simply say 1 plus, what is the rate? 91 T bill is provided to you 3.5%, divided by n, 365 by 91, raised to the power 365 by 91 minus 1. That is basically your effective annual rate. It's a simple adjustment for periodicity. If you look at it, it's more of an adjustment for periodicity. Sorry. Yep. So equivalent annual rate, and just use that to do the YTM. Questions, class. As I said, it's more of a formula-based game. If you can remember the formulas, I think in fixed income that would be great help. Some of it is relatively easy. Some formulas you will have to remember, especially add-on yield, discount methods, and then BEY, bond equivalent yield, etc. But again, it should be something which is manageable. A lot of people do it. So I don't think there should be a concern at your end also in terms of managing this. Okay. Sherry, then good. We move towards the last leg of our discussion today, which is forward rates. And I think there are a few questions that come up in forward rate category. In forward rate category, please remember writing the equation is very critical. If you don't know how to write the equation of forward rates, you will never be able to solve forward rate related questions. So what do we mean when we say forward rates? Generally, all our calculations, we assume YTM is a single discount rate and applies to future cash flows, right? So if you remember 5 upon 1 plus 6% raised to the power 1, 5 upon 1 plus 6% raised to the power 2, and we keep doing that till the last year raised to the power n. Now the problem is this 6% constant assumption is itself flawed because rates will change every second, every minute. But that is a fundamental assumption. We work with this assumption that YTM is a single discount rate that applies to all future cash flows. But in reality, different discount rates are applied based on the maturity, and these are called as spot rates. I think this should explain you why we were discounting some numbers using different rates previously. So in some of our examples before the break, we said every number will be discounted using a different rate. And the reason to use a different rate is different rates may better represent the risk from a borrower perspective or lender perspective. Yep. So in reality, discount rates differ by maturity. They are called as spot rates. Spot rates are derived from zero coupon bond yields, so they are also called as zero coupon rates or zero rates. Government generally issues zero coupon bonds, doesn't pay coupons, and this is more of a zero coupon bond, which means it will be sold at a discount and it will be redeemed at par value. To price a bond using spot rates, each cash flow is discounted using the spot rate for its specific maturity. That is, each cash flow will be a different discount rate. The bond's value is the sum of present value of all cash flows discounted at their respective spot rates. Okay, so this total will be the value of the bond. Let's give this a shot. Calculate the price of $1,000 par fair value or par value 5-year Canadian government bond with a 1% annual pay coupon. You've been given spot rates, please remember. So all your discounting has to be with the spot rate. Otherwise, then you're not going to use the spot rates. It's an irrelevant concept. This should be manageable. You should be able to solve this. Just discount your cash flows at spot rates. I think that is a simple answer. First cash flow will be 1% of $1,000. $10, second $10, third $10, fourth $10, fifth, your capital gets back, right? And then discount each of this, divide by these numbers. Example, if this is 1 year, 1 plus 0.31% raised to the power 1. This is 3 years, right? So we have to identify which of them is 3-year security. So let's say this is 2-year, 3-year, 4-year, and terminal year, which means we cannot determine today. But the second year cash flow will be divided by 1 plus 0.57% raised to the power 2. Fourth will be 1 plus 0.96%. Okay. So 96% raised to the power 4. So each cash flow gets discounted differently, and then what you get is your present value of the bond. So what we have done, we have used spot rates. We have used spot rates for discounting. And what are spot rates? Spot rates are the rates of the zero coupon bonds. Therefore, they are also called as zero rates. I don't think YTM was asked, I think, so you can ignore the YTM calculation here. Clear? Questions? Okay, then what are par rates? Fixed coupon rate, a bond would have to offer to be priced at par, in other words, YTM for specific maturity, and therefore discounting at this rate will give you the spot rate, right? So if you discount each PMT by its appropriate spot rate, Z1, Z2, Z, and remember this Z is not Z spread. I think the way they are using the notations is a bit confusing. You can call it S1, S2, S3, SN, spot rates, right? So the rates which will give you the equation equal to the face value, that is called as the par rates or the spot rates. The word par rate means this will help the bond trade at a par value. Okay, so not too bothering as a concept. Not a lot of people generally quiz this. Yep. So you'll have to actually write that the same equation like we did for Z, right? And we were calculating the Z and we said, okay, for Z, you will have to first write an equation and then solve for that equation. You will not be able to do it on your own. It's sort of a plug and play game. So in this case also, we will have to do very, very similar activity. It is asking you what should be the coupon rate at which I should pay my coupons so that I get the value equal to the par value. Par rates, fixed coupon rate, a bond that would have to offer to be priced at par, in other words, YTM for specific maturity. So we are trying to find what should be this PMT that will help us get to required rate of or required value of $100. So in this case, we'll say X is what I'm going to get. Let's say X is my number to start off with, that I'm going to get X as a return, divided by, obviously now I have different spot rates here, right? I'm working with different spot rates. So each spot rate will have to be used to discount the cash flow. 0.031% plus another X in second year. You'll also get one more coupon, 1 plus 0.57% raised to the power 2. And in third year, 100 plus X, which is your terminal value, divided by 1 plus 0.8%. And this equation, when added, all the three terms should be equal to the value of the bond at 100. So we have to solve for X. We need to see what should be the coupon rate or par rate at which the bond should be issued so that it trades at a value of $100. Remember, we are calculating the numerator here. We are calculating the coupon here. Total present value must be 100. 100 equal to X upon this plus X upon this square plus 100 plus X upon 3. Solve for X and X turns out to be 0.79744, which means your correct answer would have been 0.7974 percentage, because you will multiply that by 100 to get to this number. Questions? Okay. Then the last concept for the day, forward rates. Now, the problem with forward rates is if you do not understand the notation of forward rates, you will not be able to solve any question. The key difference is spot rate is the rates today. Forward rate is the rate starting at some future date. The notation is absolutely necessary. If you don't understand this, you won't be able to understand the topic at all. So when we write something like this, 2y, 1y, this means 1 year loan. I'm going to take a 1 year loan, but after 2 years, right? So 2y 1y means 2 years later, you are going to take a 1 year loan. 1y 2y, therefore, 1 year later, 2 year loan. So you should know how to write the equation. If you cannot write the equation, it would be challenging to solve the equation itself. Right? If you don't know how to write a 2y 1y or a 1y 1y, it would be difficult. So if I say I'm going to take a 3 year loan after 1 year, how do you write the equation? What should be the notation? I want to take a 3 year loan after 1 year. You will say 3 year loan that I'm going to take, but after 1 year. 1y, 3y. Right? So 1 year later, 3 year loan. 2 year later, 1 year loan. 1 year later, 2 year loan. Now, why are spot and forward rates are necessary? Because of no arbitrage. What does no arbitrage mean? So no arbitrage theory says you can take a 3 year loan today, right? Which is spot rate, right? And actually, let's avoid the Z. Let me write it this way. I think this is a better slide. Option one. And this Z is nothing but spot rate for now. Okay. Everywhere where there is a Z written, that means there is a spot rates. Option one, you can take a 3 year loan today. एक ही बार में you take a 3 year loan. Option two, take a 1 year loan, then after 1 year take one more year loan, and after 2 year take one more year loan. 2 year, 1 year. Option three, take a 1 year loan, and then after 1 year take a 2 year loan. Option four, take a 2 year loan, and after 2 year take a 1 year loan. So almost everything is the same. It's just written in different styles. Right? So you can say, I'm going to take a 2 year loan and then a forward rate, spot rate, spot rate, forward, spot. In a no arbitrage theory, there should be no difference in this. So whether you take a 3 year loan today or you take 1, 2, 3 loans, it should be the same. You take a 3 year loan today, you take a 1 plus 2 year of forward loan, it should be the same. And the power raised to the power 2 depends on the tenure of the loan. Because you are taking a 3 year loan, 3. In all of these, you're taking 1 year loan, therefore 1, 1, 1. 1 year loan, 1, but after 1 year, 2 year loan, so 2. The total power on the left hand side and on the right hand side of the equation has to be the same. Left hand side 3, 1, 2, 3. Left hand side 3, 1 and 2, 3. 2 and 1, 3. So the simple check is if you have written the equation properly, the powers should be consistent across the equation. You should have pretty much the same powers. So let's write a quick equation here. So calculate the 2 year, 1 year forward rate from the following spot rates and assume annual compounding. So this is where I say I don't know what exam is going to give you because the equations in the exam could be anything. So you just should know how to write the equations. What has been given to you? You've been given Z2, you've been given Z3. Okay, 2 year spot rate, 3 year spot rate. And we are looking at a timeline like this: 0, 1, 2, 3. Okay, and asked is 2y, 1y, which means 2 year later, 1 year loan. So we are saying from here to here I have to go, and then from here I'm going to take a 2y, 1y. 2 year later, I'm going to take a 1 year loan. So how should I go from 0 to 2? I should go using a Z2, right? It's a 2-year loan. So the equation will be 1 plus Z3 raised to the power 3 is equal to 1 plus Z2 raised to the power 2 multiplied by 1 plus 2y 1y raised to the power 1. So 3 both sides, because one other option was you take simply a 3-year loan rather than doing these two breakups. So you could have done this also, but we need to calculate 2y 1y. So we are going to plug in this raised to the power 3.5680% raised to the power 2 minus 1, and this equation should give you your 2y 1y. Writing the equation is very critical. If you cannot write the equation, you will not be able to solve this. So either take a 3-year loan today itself, or take a 2-year loan and then take one loan after 2 years for 1 year. No arbitrage says that the arbitrage should not exist. Doesn't matter if you take 3 or if you take this way, your rate should be equal. See this. You take a Z2 for 2 years, then take 2 year later 1 year loan. That is option 1. Or you take a Z3 total. If you take a Z2, this is the number multiplied by this Z3, this is the number. So we write the same equation, divide it, minus 1, and you will get your 2y 1y as 1.2587%. Give it a quick look. As I said, if you are unable to write the equation, forward rate, spot rate relationships will not work. And there will be a challenge in solving these questions. These are easy questions. However, it is all based on relationships. Can you draw the relationships and can you put the relationships in order? Okay, give this a try then. Calculate 3-year spot rate from the following forward rates. So see, now you have to calculate 3-year spot rate, which means Z3 to the power 3. And what has been given to you? You have been given spot rates. This. So you can write one equation like this. 0y 1y multiplied by 1 plus 1y 1y multiplied by 1 plus 2y 1y. That is equation 1. You can also write it like this, Z3 cube, because you have been given 1y 2y, this also. So you can write it like this, 0y 1y raised to the power 1 multiplied by 1 plus 1 year later 2-year loan which means raised to the power 2. So out of both the equations, whatever you want, you can use and write it, and you have to calculate Z3. This is raised to the power 1, 1, 1. So I try and look at these powers, right? These powers help me understand have I written the equation correctly. 3-year, 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 and 3-year, obviously. So the fundamental, I think the concept that runs behind this is, should I take a loan today itself for 3 years, or should I take 1 year loans 3 times? Whichever way you do, I think your number should not change, which is no arbitrage theory. Questions? Does this help? Anything that bothers you on this? You can solve it either ways, as I said. See, so if you want, you can solve it multiplying all the 3 with Z3. Or if you want, you can solve it Z3 with this and 2. Whichever way you do, your number should not change. And the easiest way is, I think you should have a timeline driven concept. You should know how to write the equation. And then it is very easy. If you cannot write the equation, I repeatedly say it will be difficult to solve spot and forward rate concept. Okay, if no questions, this is what I think we were talking about: spot curve, par curve, and forward yield curve. Spot curve shows spot rates versus maturity for a particular bond or issuer. Spot rates are usually quoted on a semi-annual bond basis, so they're directly comparable to YTMs quoted for government coupon bonds, and also referred to as zero curve or the strip curve. So this is typically government bonds. Par curve, on the other hand, shows YTM of a hypothetically bond trading at par for each maturity. Remember the keyword hypothetical. There are no such bonds generally trading. Par yields are hypothetical yields of bonds that would trade at par for a specific maturity and can be constructed from spot curve. This is, I think, your most important one because most of us work using spot curves. But in certain cases, we need a forward curve. We need to look at what the forward rates will be. So shows forward rates for bonds for annual periods in future. Typically, forward curve would show the yield of 1 year security for each future year, and this is created using spot. Right, as you just saw the equation, all the forward rates are calculated using the spot rate data. Generally, the term structure is upward sloping, right? But could be downward sloping. So when I say upward sloping, generally the term structure is like this. Short-term rates are lower and long-term rates are higher. Reason being, in short term, the risk is lower, and in long term, the risk is higher. So generally, the yield curve is upward sloping. But in certain cases, you might find a downward sloping yield curve where in short term the risk is higher, and that is typically in recession environment where a lot of people will say that in short term the return yields are higher because there's more risk because of a recession, but in long term we believe recession will finish and the yields are therefore lower. But most of the times it is upward sloping. It can be downward sloping as well. No one stops it from being a downward sloping curve to that extent. Perfect. Questions? Anything? Otherwise, we have an early finish today for you. And next time when we meet, we'll do very important concepts of duration and convexity. Very, very critical from a fixed income perspective. Okay, then we are good to close for the day. Enjoy your Sunday, and I will see you Saturday to continue fixed income. I